Having a perfect credit score or even just a really good score can change your life, and I should know because I've been on both sides of this little speedometer over here. Currently, I'm floating around the 800s, but when I was younger, I had a rogue medical bill go to collections, and that had sent my score all the way down to the low 600s. In fact, it was very close to the 500 range. And having that impact on my credit score really impacted me, not just financially, but also psychologically, because it created a really negative relationship between myself and my finances. Fortunately, I've learned a lot about what it takes to increase a score all the way from the low 600s to now the 800 range and above, and that is exactly what I want to talk to you about in today's video. So if your credit score is in the 5 to 600s and you're looking to increase it to the 700 range or even the 800 mark and above, then this video is for you. By the way, if you're new here, my name is Brian. I'm a former investment banker with a Master of Science in Finance, and my goal is to help you master finance for yourself. So when you break it down, there are really 5 factors that contribute to a credit score, and I want to walk through each one, tell you a little bit about what they are, my own experience with how these may have decreased and later increased my credit score, and what you can do about each of these factors to increase your own score. So the first one here is payment history. This one makes up about 35% of your score, and it is the biggest factor influencing whether your score is higher or lower. And this one is really straightforward because it's exactly what it sounds like. As long as you make all of your credit card payments and loan payments on time, then you're not going to have an issue with this part of your score. But that, of course, didn't stop me, because when I was younger, my dad had opened a credit card for me and it had a really low limit. It was around like $300 or something like that. And it was just something to help me get started and start building my credit history. Unfortunately, though, I didn't take the extra time to set up automatic payments to at least make sure that the minimum balance was being paid every month. And next thing you know, I got an alert on my phone that said your credit payment is past due. Now, I started freaking out. I picked up the phone, I logged in, I found the customer support number, I called frantically, and I was like, please help me. I do not want my credit score to go down. What do I need to do to fix this? And the person on the other end of the phone told me, 1, to take a deep breath and calm down, and 2, that because the late payment was within 30 days, that it wasn't going to go on my credit report. You see, what happens is you put money on your credit card, and then your statement gets generated, and you're told that you need to pay a certain amount, usually a minimum balance, within 30 days. Once you get to the end of that 30-day limit, then the clock starts on your late payment window. And what I learned from this experience is that as long as you pay within that extra 30 days, then the late payment isn't going to go on your credit report, but you are going to have to pay interest on those days that you're going by without making that payment. But the story doesn't exactly have a happy ending, because I still didn't set up automatic payments, and it wasn't very long until I missed another credit card payment deadline, and this time I had let it go more than 30 days, and it did hit my credit report. And because of this one silly little missed payment, I think it was like $20 or $30 or something like that, that stayed on my credit report for I think somewhere around 5 to 7 years. And my credit score was reduced by around 50 points for that entire duration. And if that wasn't bad enough, a few years later, I actually had a collections hit my report as well. Long story short, I made some questionable decisions and ended up having to go to the emergency room in an ambulance. And that little ambulance ride costed me around $4,000. And I looked up some questionable articles online that suggested just not paying the bill and seeing if the hospital would decrease the amount or anything like that. What ended up happening was the hospital kept sending the bill, I kept ignoring them, and eventually they stopped. And I thought, oh, maybe that's great. Maybe the hospital just got rid of the bill. They did get rid of the bill by sending it to a collections company. And one day I woke up and I saw that my credit score was in the low 600s. Now, I'm sure someone watching this is going to think to themselves, or maybe even put in the comments, why didn't you go through credit repair? You know, you could have easily gotten the credit bureaus to eliminate the collections from your record or something like that. At the end of the day, I didn't want to go through some shortcut that could potentially cost me thousands of dollars and maybe not even help my credit at the end of it all, when in reality, this was all of my own doing. So what I did instead was I vowed to not let it happen again, and I also promised myself to have some patience and see if these things would really fall off my credit report over time, and that absolutely turned out to be true. Here I am 12 years after that initial late credit card payment that I never let happen again, and when I pull up my Experian credit report today, it shows that I have 0 late payments, 0 collections, 0 derogatory accounts, and a 100% on-time payment history. So I know that was a lot for such a simple concept, just having a good payment history, but I wanted to share those examples with you because if anyone's watching this video and you have late payments, maybe you have 1, maybe you have 5, maybe you have 10 late payments on your credit report, maybe you have collections or some kind of other derogatory account, it's not the end of the world. I am a perfect example of someone who has had similar marks on their report before, and now I'm sitting here today with an over 800 credit score because of these core recommendations that I'm about to give you. The most simple one is to make sure that you have automatic payments set up for your credit cards, at minimum for the minimum balance, ideally for the statement balance. All right, so let's talk about the second factor that is impacting your credit score and is going to help you get from that 500 to 600 range up to the 700 and even the 800 range and above, and that is your utilization rate, or how much credit you are using compared to how much you are approved for. The easiest way to think about this is to take the credit limit on your credit card or add up the limits on your multiple credit cards and compare that to how much credit you have outstanding on those cards. So if you have $10,000 worth of credit limit and you currently have a $5,000 balance on your card or cards, then your utilization rate is about 50%. And there are a couple of different schools of thought when it comes to credit utilization. I've seen some folks recommend keeping it at 30% or lower for the best credit score. I've seen others say that it should be below 10%. In my opinion, the utilization rate, if you want the best score possible, should be as close to 0% as possible. The best way to do this is to make sure that you're paying off most or all of your credit card balance before the statement date. This is a set date every month where your credit card company checks the balance on your card and marks that balance on that day as how much you owe on that card 30 days later. This date is different than your due date, and the easiest way to find it is to pull up one of your credit card statements, ideally your most recent one, and when I look at mine, I see an opening and a close date. For me, my opening date is on the 5th and my close date is on the 4th. So I know that any amount that I pay on my credit card before the 4th of the month is not going to show up as a balance for the next statement. The reason it's helpful to know this is maybe you have a credit card with a relatively low limit compared to your expenses. Maybe you've got a $5,000 limit and every month you're putting about $4,000 of expenses on that card. Well, once you figure out your statement date, you can make sure to schedule your payments so that you're paying off that card, either the full balance or most of the balance, before that statement date hits. So when the statement is generated, you'll have a low or 0 balance on the card, and that is what's going to get reported to the credit card bureaus as your utilization rate. However, credit card utilization also has a little bit of a dark side. You'll remember that earlier in this section, I mentioned that it's calculated by taking your total credit limits across all of your cards and the outstanding balance that you have on those cards and dividing those numbers to get the percentage utilization. But where this can be problematic is if you have a relatively low total utilization. So let's say you're only got $10,000 worth of credit limit and you're only using about $3,000. But let's say that that $3,000 is a fully maxed out 0% interest card and you're just getting a essentially $3,000 0% loan for 12 or 18 months for some kind of introductory offer. This is exactly the type of situation that I found myself in because I saw an offer for a 0% 18-month credit card, and being the financial person that I am, I saw 0% interest and I thought, well, why don't I put my expenses on that card, max that card out. I think it had like a $10,000 or $12,000 limit. I just put all my expenses on that card for like 3 months and let that card sit with a full balance, even though my total utilization was relatively low. It was in the 20% to 30% range. What ended up happening though was without any other change to my credit report, no late payments, no collections, a good overall utilization rate, for no other reason, my credit score tanked around 50 to 100 points. So at this point, I had built up to around a 750 credit score, and I had fallen all the way back to the 650 to 680 range. Now, luckily, I didn't need to open up any new credit cards for a while. I had all the credit that I needed and I wasn't applying for any mortgages. But ultimately, what happened was that when the time came in the future to apply for another credit card and to later on apply for a mortgage, I ended up paying that card off. And within 30 to 60 days, my score jumped back up those exact 50 to 100 points, all the way back up to around the mid to high 700s. And I want to take that example and use it to teach you something a little bit more fundamental about credit scores. There's no one size fits all rule for any of these factors, because what the credit bureaus are looking for are signs of risky behavior, signs that are more likely to indicate that you are a risky borrower. So if you have someone like myself and you have a solid income and you have a good overall utilization rate, but then you see this person, aka me, suddenly open up a 0% interest credit card and max it out within 30 or 60 or 90 days, that is pretty risky behavior, or at least on paper, it looks pretty risky. So it should be no surprise why my score dropped so much when I did that. And then once I fixed it, once I paid that card off, my score went back up that same amount. And I just want to drive that point home that even though my total utilization rate was relatively low, because I was doing something that was associated with risky credit behavior, that is what tanked my score. So if you feel like your score is being held back for some reason, even though you feel like you're following all the rules, you may want to take a harder look at some of the ways in which you're borrowing money and using the credit that you get approved for. Aside from that, though, the most practical ways to keep your utilization low, as I mentioned, is to make sure to find that statement date and pay your balance before the statement date. The other thing that you can do is you can also request credit limit increases from your credit card company around every 6 to 12 months. All right, so now we're starting to move away from the quantitative side of your credit in terms of how much you have, how much you're using, how on time you are with your payments, and we're starting to move towards the qualitative side, which is more about the overall profile of your credit history. And I know this isn't very YouTuber of me to say, but you could stop watching this video right now, just apply everything I've said up to this point, and you will have a very good credit score. In fact, I'm very confident that if you just follow all the tips I've mentioned up to this video, over a 5 to 7 year period, you will have over a 700 credit score and ideally closer to the 780 range. But if you want to give yourself the best shot of having the best score possible, or maybe you're close to the 800 range, but you haven't been able to crack it just yet, then the next 3 factors, while individually really small, all together are going to help you get over that hump and have the best score possible. So first up for these smaller factors is the length of your credit history. This is going to make up about 15% of your report, and this is simply the average age of all of the accounts that you have on file. As I'm sure you can already tell, this is going to be a relatively hard number to move, especially if you're like me and you have quite a few accounts open. Those additional accounts that you open are going to be on the younger side, and they're going to bring your average age down. And if you want the best score possible, if you really want to get to that 800 to 850 range, well, FICO tells you exactly the average age that they're looking for. They say that the number is around 10 years. And while there's no way to really artificially increase this number, I do have a recommendation for you based on my own experience to prevent this number from going down. If you remember from earlier in the video, I mentioned that I had a credit card in my name when I was very young, and it had a very low balance of around $300. But regardless of the limit, because I had opened that card so long ago, it was really helping to increase the average age of all my accounts. That was until I stopped using the card and didn't have any balance on it whatsoever, and next thing I knew, life came at me very fast, and that bank had closed the account. In fact, this is very common. If you let a credit card sit with a zero balance for around a year, your bank is going to start asking you, hey, do you still want to use this card? And if you don't respond within a certain amount of time, usually all you need to do is put at least one transaction on that card within a certain time frame. They will close the card. And if your bank closes a card, this isn't considered a derogatory mark on your account, but you lose that older account that is helping to bring the age of your overall credit history down. And what will happen is your credit history will start to look a lot younger. And in this case, taking a few years off is not the best sign for your credit score. So my biggest recommendation to keep this part of your score healthy, especially if you're someone like me who has quite a few credit cards and maybe some old ones that we use for specific sign-up bonuses or perks, make sure to put at least one little subscription charge on that card to keep it active over the years. The fourth factor is the amount of new credit that you're both applying for and that you are actually getting. And this is another one that, while it doesn't have a big impact on your score, it's about 10%, it is the most actionable of these three that we're talking about right now. Now, I'm sure you've heard plenty of times that it's okay to apply for a credit card or for a loan. It's not going to hurt your credit report. It might lower your credit score just a little bit, but it's not going to affect your interest rate, and it's going to go away after a few months anyways. But keep in mind that we're trying to have the best credit score possible. And if you really want to get into the high 700s or even break that hump and get into the 800s, then you're going to want to make sure to limit the amount of new credit lines that you're applying for. And if you want a goal to set for yourself, well, FICO has explained that their high achievers, folks that have scores between 800 and 850, haven't opened a new credit line in over 3 years. Now, just like with the last factor, I think it's important that we set our expectations for this one. I know myself and probably many others watching this video get new credit cards maybe 1 or 2 or even 3 times per year. And there's really no way around submitting a credit application for those new credit lines. But even though I filed 3 credit applications in the last year, I still have a credit score in the 780 to low 800 range. So like I said, for these, it's not the biggest deal ever, but if I wanted to get up to that 850 range, I would probably have to hold off on applying for any new credit for at least 3 years. So let's talk about the last factor of the 5 that go into calculating your credit score, and this is your credit mix. And I'm going to keep this one relatively short and sweet because throughout my entire credit history, I don't think this has ever gone below exceptional. And I think I have a few theories as to why it stayed good and what could make this go lower. So if you find that your credit mix is a little bit of a yellow or red flag on your report, here is my theory as to why. You see, the whole purpose of this score and the model that goes into it is to identify risky behavior. So I think standard credit cards with major banks and standard loans like auto loans and mortgages with major institutions are probably just fine and won't impact this part of your score at all. However, if you find yourself diving into more unconventional loans, like say a payday loan or a point of sale loan, then these types of loans may be seen as a little bit more risky by the credit bureaus and may start to degrade your score around the edges if you have those type of loans on your profile. So my biggest tip here would be that if you have any concerns about your credit mix, take a look at the types of loans or credit that you have and consider paying off or closing any accounts that are not major credit cards or auto loans or home loans from major banks. All right, so we've talked about the 5 major factors that go into a credit score. We talked about how much they impact your credit score, how they're defined, and my own personal experience of how these various factors have either increased or decreased my own score. So I want to use this section to quickly summarize for you how you can use this information to help you get a great credit score. First up is related to payment history. Make sure that you set automatic payments at least to the minimum balance, ideally at the statement balance, and make sure that your cards are getting paid on time every month, no excuses. Next up is your amount of debt. And I'm going to draw a line in the sand here and say that 10% or less is probably the ideal amount of credit that you want to be using each month if you want the best score possible. And we talked about some strategies to help you make this happen. Number 1 is to find your statement balance and schedule your payments to be made before that statement date. And number 2, you can request credit limit increases from your bank. Number 3 is the length of your credit history. And for this one, just don't let your card sit with a zero balance for a long period of time. Make sure to schedule an extra subscription payment with that card, or set a calendar reminder for yourself every 6 to 12 months to bring those cards out and pay for something, say at the grocery store or when you go shopping. 4th is related to the amount of credit that you're applying for and getting. So my pro tip here is don't apply for new credit lines unless you really need them. And if you want the best score possible, try to go 1 to 3 years without applying for any credit at all. And then when it comes to your credit mix or the types of credit that you have on your account, try to stick to common credit cards from major institutions as well as home loans and auto loans, and try to stay away from riskier loans or loans that can be perceived as risky, like payday loans or point of sale loans. And if you're curious which credit cards specifically I use and recommend for others, you can check them out in this video here. Otherwise, I hope you enjoyed this video. I hope you found it helpful, and I will see you in the next one.